Welcome to the deep dive. Our mission today is a really deep exploration of an industrial transformation. We are unpacking the complex investment case for the Bluebird Corporation, ticker BLBD.
Right.
This is one of North America's big three school bus manufacturers, a company that has been, literally defining the school commute experience since it was founded, nearly a century ago, back in 1927.
That near century of history is fascinating, but the real challenge and the whole investment story, it's happening right now.
Exactly.
We're asking the core question here. Can this iconic, century-old industrial giant successfully execute its transition into a modern, electric-focused growth engine?
And is that enough to make it a compelling investment today? Or is this recent profit surge just, a temporary cyclical bounce?
That's the question.
Yeah. And this isn't just about reading a quarterly report. We are diving deep into a comprehensive investment memo. It covers everything from their near-death financial experiences to their strategic pivots and future projections.
And that survival story is key. It required intense discipline, and now their growth requires, some pretty aggressive foresight. The current financial snapshot is striking, really, because it represents such a complete reversal of fortune. The investment thesis, it really boils down to successful internal operational fixes meeting a massive, externally driven market shift.
The shift toward electrification.
Exactly. That combination led to this massive financial rebound in the early 2020s.
And when we talk about scale, we should probably give some context. They've built over 550,000 buses since the company's inception.
It's an incredible number.
And today, they maintain a very healthy, very consistent market share, typically sitting somewhere between 25 and 35% of the U.S. school bus market. They're right up there, rivaling major players backed by giants like Daimler.
And that scales the foundation. Financially, the turnaround is it's undeniable. Their fiscal year 2023 revenue had a record high of about $1.13 billion.
And that figure wasn't just incremental growth.
Right. No, not at all. It marked a sharp swing from recent losses caused, largely by that pandemic-era supply chain chaos back into meaningful profitability.
That kind of rapid structural turnaround absolutely demands we look closely at the specific catalyst that drove it.
For sure.
Okay, so let's unpack that core rationale. What are the three key interlocked drivers that are currently fueling Bluebird's recent dramatic performance? What's underpinning this whole bullish investment case?
Well, the performance isn't built on just a single factor. It's a function of seizing a technological opportunity and capitalizing on a market correction at the exact same time.
Driver number one seems undeniable. Their leadership in EV and alternative fuels.
Yeah.
We're playing catch-up here.
Not at all. The Bluebird was a very early mover, not just in electric vehicles. They've had EV units in operation since 2018, but their foundational strength really came from alternative fuels like propane and compressed natural gas or CNG.
And they have, over 20,000 low or zero-emission buses operating on the road today?
That's right. And that deep experience with integrating complex, non-diesel powertrains and, just as importantly, servicing them through their dealer network, that gave them a massive head start in the electrification race.
So they already knew how to handle new fuel systems safely, reliably.
Which is huge in this risk-averse industry.
Yeah.
But the most immediate concrete catalyst driving sales today is, without a doubt, the massive government funding environment.
You're talking about the EPA's Clean School Bus Program.
Exactly. That program is providing over $5 billion in funding between 2022 and 2026. And it's specifically to accelerate the adoption of zero and low-emission buses.
And this funding, it doesn't just offer incentives, right? It translates directly into orders.
Directly into non-cyclical, high-value orders for Bluebird.
And we saw that immediate impact. In the first phase of rebates alone, that EPA program generated orders for approximately 550 Bluebird electric buses.
Right. And given the high price point of an EV bus, that translated into roughly $200 million in instant revenue visibility.
Just from that initial governmental push.
That governmental pull, it validates the product strategy and gives them fantastic volume, which leads to the second major driver supporting the thesis. And this one's simpler. It's purely cyclical, pent-up demand.
Right. School districts are incredibly conservative spenders. They drastically deferred purchases during the pandemic years, putting that money elsewhere.
And that deferral has consequences. It pushed the average age of the school bus fleet across the country to, frankly, dangerously high levels.
So a massive replacement cycle was inevitable once funding stabilized.
And that reversal is fully underway now. Entering fiscal year 2024, Bluebird was sitting on a backlog of approximately 4,600 buses.
4,600. To put that into perspective, that backlog represents roughly two-thirds of a full year's expected production capacity.
Already locked in.
A backlog that size provides not just revenue visibility, but phenomenal insulation against any sudden market weakness or, competitive price pressures in the near term.
For sure. And the third driver, and this is perhaps the most vital one for long-term health, is the internal operational fixes. Management didn't just sit around and wait for the market to fix itself.
No, they took aggressive control of what they could internally.
Yeah.
We need to remember the chaos of 2021 and 2022. They were struggling heavily with bottlenecks, everything from chip shortages to engine delays.
They were stuck. They were delivering fixed price orders that were effectively losing them money because of rampant, unexpected inflation.
So what do?
The management team, under the guidance of the interim leadership at the time, just went on a pricing and efficiency offensive. They focused intensely on pricing discipline, making sure new orders reflected current costs and synchronizing their supply chain.
So that incomplete buses didn't just clog up the assembly line at their Fort Valley plant.
Exactly. And the execution was masterful.
The numbers show it. Unit sales jumped 25% year over year in FY 2023. And even more critically for the margins, the average selling price, the ASP, rose by a decisive 15%.
Holding that structural price increase proved they had regained significant pricing power in the market.
Yeah, they turned a disastrous situation where gross margins were near zero or even negative into a healthy double-digit margin profile in just 12 months.
And these efficiency and pricing gains, they appear to be structural, not just temporary.
Okay, that turnaround is impressive, but we have to approach this with, appropriate skepticism. Why should we believe these tailwinds translate into long-term value creation? What are the immediate inherent risks we have to weigh against this incredible story?
That's the core of the deep dive, right? The first major risk, and it's the one that nearly killed them in 2022, is the persistent danger of supply chain disruption and input inflation.
They're a heavy industrial company.
Exactly.
Right.
Relying on complex global supply chains, they rely heavily on key suppliers like Cummins for all their diesel engines and drivetrains, and they have to rely on external partners for those increasingly expensive battery packs for the EVs.
And the anecdotal evidence of this fragility is pretty clear, right?
Oh, yeah. In 2022, they had an $8.8 million inventory write-down. That charge was a direct result of cost overruns on fixed-price contracts signed before the inflation spike.
So that just highlights how quickly renewed shortages, whether it's semiconductors or specialty battery metals, could just constrain deliveries or let supplier costs soar.
And crush those hard-won margins.
Right. So risk 2 is a competitive one, the competitive response. Bluebird may have an early lead in EV, particularly leveraging these government programs, but their legacy rivals are. They're giants.
We're talking about Thomas Built Buses, which is backed by the global industrial power of Daimler Truck.
Right.
And IC Bus, which is owned by Navistar, part of Volkswagen's Triton Group.
These companies have massive balance sheets and are now aggressively pushing their own electric models. And there are new entrants, too, like Canada's Lion Electric, targeting that EV niche.
Very aggressively, often with compelling financing packages.
So what I want to know is, how does Bluebird's offering structurally compare to these giants? The memo noted that Bluebird builds its own proprietary chassis, but Daimler and Navistar adapt standard truck chassis. Does that difference truly matter enough?
It matters hugely in this specific segment. A truck chassis is optimized for, hauling freight and long-haul durability. Bluebird's proprietary chassis, as we'll get into, is engineered specifically for the school bus mission.
Okay.
It prioritizes things like driver sight lines, passenger safety, a tighter turning radius for residential streets, and durability under constant stop-start conditions. So while competitors have huge resources, they're adapting something Bluebird is building from the ground up.
That structural difference, it acts as a barrier.
It does. A barrier to rapid market entry for truly optimized competing products.
That makes sense. Okay, risk 3, and this is always critical in a turnaround story, is execution and turnover. This company has seen frequent leadership changes, 3 CEOs in just 4 years, between 2021 and 2025.
That kind of C-suite churn poses significant continuity challenges. Now, the previous CEO, Phil Horlock, he returned for a stabilizing interim period and executed that turnaround brilliantly.
But maintaining that momentum requires long-term stability.
Of course. The new CEO, John Wiskill, who started in February 2025, He's a 35-year automotive manufacturing veteran. That background is a major plus. It signals a return to deep operational focus.
So his challenge is to embed and maintain that operational discipline that was just established under, frankly, extreme duress.
Any slip-up, especially as they ramp EV production, could rapidly erode those margin gains and, investor confidence.
And a final risk we should frame here, cyclical and regulatory factors. School bus sales depend heavily on school budgets, local tax revenues, state funding.
All of it. If there's an economic downturn or if that federal funding like the EPA program dries up or shifts, demand for new buses could weaken rapidly.
Conversely, failing to meet evolving mandates is also a risk. I mean, you see regions like California mandating zero-emission school buses by the mid-2030s.
Right, so Blue Bird's leadership in EV is a strength right now, but they have to continuously outpace or at least match that regulatory velocity.
Otherwise, their technological moat could quickly become a liability if they lag behind.
Exactly. And to really understand how they'll manage these persistent inherent risks, we have to look back. We have to look at the company's DNA, the lessons learned from surviving a century of industry chaos.
Okay, let's do that.
Let's delve into the company's foundation. So Blue Bird was formally established by Albert L. Luce Sr. in 1932. He was expanding on an initial transport business he started in 1927.
And the culture was shaped by him, right?
Completely. The foundational culture was dominated by his conservative, cost-focused ethos and a famous no-waste mantra. This deep-seated frugality born out of the Depression just became the permanent DNA of the company.
And that DNA wasn't just about saving money. It was about quality and, really, industry leadership. Bluebird engineers were true pioneers.
They were. They helped establish the now iconic school bus yellow color back in 1939. And even before that, in 1937, they introduced the all-steel bus body,
Which set the industry standard for durability and, most critically, safety.
That legacy of safety is the company's original and most powerful competitive moat. The lesson from those early decades is that conservative growth and an unwavering focus on the core product student transportation safety allowed them to weather major industry downturns.
Especially that recession in the 1980s, when a lot of their peers either merged or just collapsed.
Right. But here's where the narrative takes a sharp turn. It gets a bit more complicated. The post-war economic boom created a kind of identity crisis for the Luce family management.
They felt they needed to diversify.
Yeah, diversify beyond the reliable but maybe unglamorous yellow bus market.
So they launched the famous Wanderlodge luxury motorhome in 1963.
A very different market, catering to high net worth individuals. And later they ventured into transit buses, the City Bird, in the 1970s. These were attempts to leverage manufacturing know-how, but they were largely distractions.
And distraction leads to financial stress. By the 90s, after the family sold the business in a leveraged buyout, and then later through ownership by the UK-based Henleys Group, the financial foundation just crumbled.
Which culminated in the near-death experience, the 2006 Chapter 11 bankruptcy filing.
Wow.
Yeah. The debt load, coupled with the drain from those non-core operations, it just proved fatal to the structure, if not the brand itself.
It must have been a painful reckoning. And then the private equity firm, Cerberus Capital Management, acquired them out of bankruptcy.
And their action was brutal, but it was necessary. It was a radical surgical retrenchment.
What did they do?
Cerberus's team cut or divested all non-core lines. That included selling off the beloved but financially draining Wanderlodge RV business.
That's like selling the family jewel.
It was. But it was essential to save the core business of yellow school buses, which were then consolidated entirely back to the Fort Valley, Georgia plant.
So that traumatic incident, it really cemented the core lesson that management operates under today. Focus on your single mission-critical competency.
That painful retrenchment saved the business and cleared the debt slate, allowing for future investment.
So after the Cerberus era, the company truly revitalized in the 2010s under CEO Phil Horlock.
Yeah, he drove the first major strategic pivot toward modern technology.
Horlock didn't just stabilize things. He went on the offense, using the company's manufacturing expertise. He made that bold early bet on alternative fuels.
Aggressively pushing propane and CNG buses starting around 2012, and this was well ahead of any major regulatory mandates.
And that proactive innovation was key. It meant Bluebird secured market leadership in that alt-fuel segment very quickly.
And the financial results were dramatic. Revenues climbed from roughly $550 million to $1 billion by 2016.
$1 billion.
Yeah, and they gained about 10 points of overall market share. This successfully laid the essential groundwork, both technologically and strategically, for the current EV transition.
And that success provided the platform for their return to the public market. They went public via a SPAC in 2015.
Which provided crucial capital not just for debt reduction, but also for R&D. Specifically, it funded that early electric bus program, which started demonstrating vehicles by 2018.
So when you look at that long arc, from the survival mode frugality of the 30s to the traumatic refocus in 2006 to that bold alt-fuel bet in 2012, it reveals a strategic DNA.
Yeah, a DNA focused on resilience and adaptability. They've shown a willingness to make radical cuts when necessary and to proactively lead on technology when the opportunity arises. This history is why we can have some confidence they understand the magnitude of the current EV transition.
That's a powerful narrative. They know how to survive, and now they seem to know how to lead in innovation again. Okay, let's dig into how that DNA translates into competitive advantage and market share in today's electrifying market.
Let's do it.
Let's start with the core business structure and revenue mix. Blue Bird is primarily a manufacturer of large vehicles, so roughly 85 to 90% of revenue comes from new bus sales.
But that remaining 10 to 15% is the often overlooked but higher margin aftermarket parts and services business.
That small segment is vital for stability. But let's talk products first. Blue Bird offers a full lineup, covering every school district need. They have Type A, Type C, and Type D buses.
Right.
For listeners who might be less familiar with those industry classifications, can you quickly orient us? What are the practical differences between a Type C and a Type D, which seem to be their core large bus offerings?
Absolutely. So think of Type C buses like the classic Blue Bird vision as the conventional school bus. It has a forward hood with the engine in front of the firewall. This is the largest, most common segment in the market.
Okay, the classic yellow bus we all picture.
That's the one. A Type D bus, or a transit-style bus like the All-American, has the engine either partially or fully behind the front axle or at the rear. These are usually high-capacity buses, often seen in denser urban districts or on highways,
where visibility and maneuverability differ slightly.
Exactly. And Blue Bird provides all three categories, covering that full spectrum of district needs, often through their unique manufacturing advantage.
And that leads us right back to that crucial competitive differentiator. Blue Bird is the only major school bus maker that builds its own chassis specifically engineered for school buses.
Vertically integrated on the foundation. This is a major structural advantage that directly appeals to risk-averse buyers.
Right.
As we touched on earlier, competitors like Thomas Built and IC Bus have huge R&D budgets, but they typically adapt a standard commercial truck chassis designed for freight.
So Blue Bird's vertical integration allows them to optimize their chassis from the ground up.
From the ground up, not just for safety features, but for durability, driver ergonomics, and crucial operational features like a tighter turning radius, which is essential for navigating crowded school zones and cul-de-sacs.
So that proprietary chassis forms one layer of their moat. What other factors reinforce Blue Bird's entrenched position against the deep pockets of their rivals?
We can break their competitive defense down into three key moats. First, you have the reputational moat.
The brand.
The brand is synonymous with safety. School districts, trustees, parents, they all prioritize safety above everything else. They favor vendors with, 100 years of proven reliability and certification.
New entrants simply cannot buy that level of trust.
Not in a mission-critical industry like this. The second moat is distribution. They rely on an ecosystem of over 50 exclusive dealers across North America, and these dealers are far more than just sales outlets.
They are the local service centers, warranty providers, political liaisons.
For decades, this local network handles the complex parts inventory, provides maintenance training, which is getting more specialized with EVs, and manages the whole local bidding process.
So this entrenched dealer network is a massive barrier to entry.
Huge. Upstarts like Lion Electric face immense difficulty trying to replicate that comprehensive service and support infrastructure overnight.
Okay, and the third moat is technology, which they are leveraging with their history.
Right. They successfully carved out an estimated 80% market share in the propane school bus segment after their initial aggressive push.
And that alt-fuel history is their playbook for EV.
It's the exact same model. The early entry into EVs demonstrating units by 2018 is leveraging that playbook. Prove the technology works, ensure your dealer network can service it, and scale it through that trusted relationship structure.
So their credibility as a low-emission technology leader is giving them an outsized advantage in this initial wave of electrification funding.
That's what we're seeing.
Let's translate this into market sizing and that EV growth kicker. The North American school bus replacement market is stable, right? Around 30,000 to 35,000 units a year.
Right. Historically, this meant stable but pretty flat revenue in a $3 to $4 billion market.
But the EV shift fundamentally changes that investment profile.
Completely. Electric buses cost $300,000 or more. That's 3 times the price of a standard diesel bus.
So as EVs take a growing share of that annual replacement volume, the dollar value of the serviceable available market, the SAM, is expanding dramatically.
Even if the unit volume stays stable, this is the engine that transforms a mature industrial replacement business into a legitimate growth story.
And Blue Bird is capitalizing. They are claiming a leading portion of the estimated 2,500 electric school buses funded or ordered nationwide by 2024.
Which suggests a 40 to 50% share of initial EV deployments, well above their legacy unit share.
Wow. If they can sustain even half of that EV market share dominance, it pretty much guarantees a higher revenue trajectory for the next decade.
They're successfully bridging that stable, mature replacement business of diesel and propane with the high-growth emerging engine of EV.
We should probably loop back to that aftermarket parts segment too.
We should. While it's only 10 to 15% of total revenue, it carries the highest margins and contributes crucial stability. The total school bus parts market in North America is estimated at over $1 billion annually.
And that aging installed base is their captive audience. They have around 180,000 Blue Bird buses currently in operation.
So every new Blue Bird sale is effectively an annuity. It locks in 15 years of future high-margin parts revenue.
Right, because parts revenue carries an estimated gross margin of, what, 30 to 40%?
That's right. So that stream is essential for mitigating the cyclicality inherent in new bus sales. When new bus sales dip, the parts business acts as a powerful buffer.
And the company has been deliberately putting more emphasis on this segment. Parts revenue grew 27% in FY 2023.
Which reflects both the aging fleet and management's focus.
So the foundation is solid. Proprietary chassis, deep-rooted reputation, a strong dealer moat, and a high-margin annuity stream. Now, let's see how they translated these structural advantages into that recent dramatic profit recovery through superior operational execution.
The operational transformation that happened throughout 2023 was the inflection point that drove the stock performance. We have to remember what the plant floor looked like in 2021 and 2022.
Just incomplete buses cluttering up the Fort Valley facility.
Exactly, because they were missing just a few critical chips or engines. This dramatically hampered throughput and inflated their costs.
So they successfully synchronized their supply chain in 2023. It's not a glamorous fix, but it's absolutely essential for an industrial manufacturer.
And unit volume immediately shot up 25% year over year in FY 2023.
Which shows they cleared that backlog of half-built products and got their production flow back in sync.
Now, the next challenge is capacity expansion to meet that surging EV demand, especially with the large government backlogs. Management is now targeting a production ramp toward approximately 60 buses per day.
60, up from their 2023 average of about 34 per day.
Yeah.
That's a huge lift, nearly doubling production efficiency. The memo suggests that they're aiming for this primarily by using partial second shifts. Does that qualify as a truly capital-light approach? Or will they need significant automation to hit those numbers without new execution risks?
That's the critical distinction. It is capital light relative to building an entirely new plant, which would be that historical mistake they avoided in 2006.
Okay.
By using second shifts, they are leveraging existing fixed assets. The plant, the main production line. The investment goes primarily into labor training, inventory staging optimization, maybe some minor automation, but not multi-million-dollar plant construction.
So the risk is labor availability and quality control during the ramp-up.
Right. But the capital expenditure required is minimal, and the financial benefit of this leverage is already showing up in their operating expenses.
SG&A as a percentage of revenue dropped from about 15% to approximately 12% in FY 2023.
So when sales jump and overhead grows slower, that operating leverage flows straight to the gross margin and EBITDA. And this discipline is what paved the way for the decisive turnaround in unit economics and the margin rebound.
We've already noted that in FY 2022, they were selling some buses at a loss, fixed contracts, raging inflation. But by FY 2023, the recovery was astonishing.
The average gross margin per bus rebounded sharply to approximately 12.3%. That translated to an average of about $16.3 thousand in gross profit per unit.
And that recovery was achieved by successfully holding that aggressive 15% average selling price increase combined with the stabilized production costs.
The willingness of the market, of the school districts, To absorb that 15% price increase, it speaks volumes about Bluebird's pricing power.
Right. It suggests they're not easily substituted. It reinforces the strength of that brand and dealer mode, especially when government funding is readily available.
And another crucial point for the future margin structure is EV margin parity.
Meaning,
Bluebird made it clear they are not trying to buy market share by selling their electric products cheaply. Their EV bus gross margins are now approaching parity with their diesel margins.
which is fantastic considering the enormous cost differential of the EV battery pack compared to a diesel engine.
The only way they can achieve that parity is through price support. Government subsidies, particularly the EPA program, they support the higher sticker price of the EV bus, allowing Bluebird to maintain its 12+% gross margin target without compromising profitability.
That's a massive operational win. It proves they're scaling high-growth products profitably from day one.
It does.
Now let's talk about that annuity stream again, the concept of lifetime value, or LTV, in the context of a yellow bus. We usually associate LTV with, a recurring revenue subscription. How does it apply here?
It applies because every bus sale initiates a 15-year parts and service relationship. Bluebird calculates the LTV by estimating the total parts and service revenue generated over the bus's expected 15-year lifespan.
And the goal is to capture, 10 to 20% of the bus's initial price in parts revenue over that lifetime?
Exactly. And since those parts carry that 30 to 40% margin, that means the cumulative profit from the aftermarket often rivals or even exceeds the initial profit from the bus sale itself.
That's incredible.
It is, and that's why parts revenue grew 27% in FY 2023. It's a reflection of that large, aging installed fleet, around 180,000 buses, that requires more maintenance and management's renewed focus on capturing that spend.
So this high-margin recurring revenue is a powerful stabilizer against the cyclicality of new bus sales.
A very powerful one.
So the operational narrative is robust. They fix the flow, push through pricing, they're scaling capacity efficiently, and ensuring the high-growth EV products maintain margin discipline. That successful execution forms the bedrock for the impressive financial results we're seeing now.
That's the whole story.
Let's turn to the financial velocity then. The profit surge is the most eye-catching part of the story. Adjusted EBITDA, a key measure of operational profitability, hit a record of approximately $88 million in FY 2023.
Which is a 7.8% margin, and this is up from a negative $15 million in FY 2022.
That swing is the definition of an inflection point.
And the positive momentum hasn't slowed down. It actually accelerated into fiscal year 2024, with net income surging to approximately $91 million in just the first 9 months.
Wow.
As a result, the company confidently raised its full-year FY 2024 guidance for EBITDA to approximately $115 million, targeting a 10% margin.
And beyond just the earnings power, the company is generating hard cash. Free cash flow turned definitively positive in 2023, generating roughly $34 million.
And this is a critical psychological and financial transition. It moves Bluebird from a capital-consuming phase, where they were funding R&D and covering losses, to a sustainable cash-generative model.
And that rapidly improving cash flow dramatically strengthens the balance sheet.
It does. Leverage, measured by the ratio of net debt to EBITDA, is quickly falling below 1.0x by 2024. For an industrial manufacturer in a growth phase, a sub-1x leverage ratio demonstrates strong financial conservatism and flexibility.
And we're also seeing discipline in their capital efficiency. The return on invested capital, or ROIC, improved significantly to an estimated 15% in FY 2023. For those unfamiliar, why is this metric so important for an investor?
ROIC measures how effectively management uses the capital they receive from equity and debt to generate profit. So if their ROIC is 15% and their estimated cost of capital is typically around 10% for a company like this, they're generating value above the cost of raising that money.
So a rising ROIC demonstrates that the turnaround isn't just about survival.
It's about actively creating shareholder value.
This financial health has led to a pretty significant shift in capital allocation priorities. After years of focusing on operational recovery and R&D, management authorized a substantial $100 million share repurchase program.
Set to begin in FY 2025. This is a massive signal from the boardroom.
What does it communicate?
It communicates management's confidence not just in achieving sustained profitability, but in maintaining it. They believe that repurchasing shares at current multiples, around 8 times forward EBITDA, is an accretive use of capital.
But doesn't that strategy warrant a critical look? I mean, they're still in a high-growth phase with massive EV demand ramping up. Shouldn't they be prioritizing accelerated EV capacity expansion, maybe fully automating some lines, or even aggressively paying down debt instead of a buyback?
That's a fair question, and it speaks to their financial priorities. The decision implies two things. First, they believe that capital-light capacity ramp, the partial second shift strategy, is sufficient for the current demand.
Okay.
Second, it suggests they see limited external growth projects, like a major M&A opportunity or a plant expansion, that would offer a better return than buying back their own stock, which they clearly view as undervalued.
So it's a pragmatic, conservative approach to cash management.
Especially since they don't pay a dividend.
Right. Now, let's wrap this up with the valuation context. Based on these surging financials, the stock is currently trading around 10 to 12 times forward EBITDA and 15 to 20 times forward earnings.
And this multiple reflects the market consensus. It positions Bluebird firmly as a growth-oriented industrial stock, not some cheap cyclical manufacturer.
So the market is pricing in two things.
Right. Confidence in further margin expansion towards that 12+% EBITDA margin long-term target and the revenue visibility provided by that strong long-term backlog.
And finally, dilution risk is low.
Yeah.
Since the company is now cash generative and actively buying back shares, it's a net buyer of its own equity.
Which is a significant governance improvement and a strong sign of management's conviction in the long-term equity story, particularly compared to the dilution risks inherent during the previous SAC era.
Right.
We should probably revisit the issue of leadership continuity. The quick succession of CEOs was an acknowledged point of risk. When a leader suddenly leaves, it often disrupts strategic momentum.
But the company has clearly worked to restore stability. They brought in John Wiskill, a 35-year automotive manufacturing veteran, as CEO in February 2025.
And that choice signals a commitment to deep operational expertise over pure finance or sales experience.
Furthermore, they're enhancing governance by transitioning to an independent board, with a new chairman coming in 2024.
So if we synthesize the management scorecard, leadership rates strong overall despite the recent churn. The previous team excelled in strategic vision, that EV push, and operational execution, the turnaround.
And Wiskill's mandate for operational excellence ensures the focus remains precisely where it needs to be.
Scaling EV production efficiently and maintaining quality control during that ramp-up phase.
Okay, so let's conduct our forensic review. Are there any hidden issues, complex accounting practices, or major regulatory flags lurking beneath the surface of this impressive turnaround?
Starting with accounting cleanliness, Bluebird reports using standard GAAP, and there have been no major restatements or signs of aggressive revenue recognition.
And that $8.8 million inventory write-down in 2022.
While a large loss, it was candid and transparent. They took the medicine up front, which is a sign of conservative, not aggressive accounting.
And on internal controls.
No material weaknesses were reported. The management team addressed the inventory issue by immediately adjusting pricing policies and tightening inventory controls. They reacted decisively to the failure point, which suggests a healthy control environment.
Legal and regulatory risks seem routine.
Yeah, standard product liability inherent to the industry. But there are no major ongoing lawsuits, class actions, or regulatory fines that pose a material threat to the business model or the balance sheet.
But the perennial strategic risk, which they can't fully eliminate, remains supplier concentration.
Right. They are dependent on Cummins for all their diesel engines and drivetrains. If Cummins faces a major strike or a catastrophic disruption, Bluebird's entire conventional line would just halt.
It's a structural vulnerability.
It is, but management learned a harsh lesson in 2021. They're now mitigating this by proactively increasing safety stock of critical components and pursuing dual sourcing efforts where it's feasible.
Though finding a substitute for a highly specialized engine manufacturer like Cummins is challenging.
Very. But crucially, the move toward EV mitigates this risk over the long term, as the EV drivetrain components have different suppliers.
So the inference from this forensic review is a relatively clean bill of health.
Yeah. Bluebird is operated with prudence and transparency. The quality of the earnings turnaround seems sustainable, and the focus now shifts entirely to operational execution under the new leadership team as they pursue that 60 bus per day target.
The leadership team today has successfully married the conservative nature of the founding era with the bold strategic vision required for the electric future.
Exactly. They are focused on sustainable, profitable growth, not reckless expansion.
Okay, let's synthesize our key takeaways. The investment thesis is strong. Blue Bird successfully navigated its operational crisis and is positioned as the clear market leader in the high-growth electrification segment of the school bus industry.
And they're leveraging their unique historical advantages to do it.
Financially, the turnaround has structurally lifted the margin profile. Adjusted EBITDA margins are trending toward 10% and have the potential to hit 12% in the long term.
Which ensures strong, consistent cash generation.
Finally, the discipline is evident in their capital allocation. Management is successfully balancing essential growth investments, primarily that EV capacity enhancement, with prudent capital return.
Evidenced by the $100 million buyback authorization, this demonstrates sound financial stewardship, especially after that private equity control era.
Blue Bird stands as a compelling case study of a legacy manufacturer successfully reinventing itself for a new technological era. They are leveraging nearly 100 years of brand goodwill, safety reputation, and distribution dominance to capture the massive government-funded shift to zero-emission transportation.
They're effectively converting a stable industrial market into a legitimate high-margin growth opportunity.
And their history provides the instruction manual. Focus on the core product, manage debt conservatively, and lead on technology.
And they are executing on all 3 points today.
So we'll leave you with this provocative thought to consider. The company's long-held reliance on its single Fort Valley, Georgia plant proved highly efficient during stable times, but it became a rigidity during the 2021 supply crisis. As EV demand accelerates and potentially outstrips even the planned capacity increase to 60 buses per day, will management have to risk repeating the historical mistake of overexpansion by adding costly regional facilities? Or can they maximize current capacity expansion via shifts in automation alone?
That's the core dilemma.
This capacity dilemma, balancing growth with prudence, is the core operational challenge they face moving forward into their second century.